Hi, I'm Nino Gonzalez, and welcome to another episode of Making Sense. Well, in a previous episode, I had brought back one of my accounting students, Claudia Garcia, and we had gathered some questions that El Paso Community College students had, financial literacy questions. And we just ran out of time, and we only got to cover about half of the questions. So I brought her back to cover the second half of those questions that our students had and to provide them a little bit of advice. Well, thank you, Claudia, for coming back and agreeing to finish up the questions that our El Paso Community College students had. So let's get started right into them.
Okay, well, which of these individuals needs life insurance the most? I have a single mother with two young children, a two-income married couple without children, an elderly widow.
An elderly widow. Okay, so who do you think needs the life insurance?
Well, my common sense tell me a single mother.
A single mother with two young children.
Yes.
And that's usually the case. I think we need to have life insurance if we pass away and we need to leave support for minor children or even a spouse that might not be working. The second choice was what, a two-income married couple. Mm-hmm. Well, it all depends on how much each spouse earns, and but if they're both equally about the same, then maybe the life insurance might not be as necessary as somebody who's going to leave two young children. Now, another issue we get into, and that might be a future show, is how much life insurance do we need, and when should we apply for it? Because sometimes if we wait too long in our later years, the premiums go up. Plus, you might not get insured because of health problems. So, but that's another show where hopefully I can bring in an individual who knows a little bit more about life insurance, and they can go over that with us.
Yeah, because sometimes we think I'm not needed now, so I think I need that
I know.
later.
And
when
then
you need it.
do you really think $10,000 of life insurance is enough? Probably not.
Probably not. I have another question. Which of the following item is not part of my credit report? My credit card balance, my payment history, or my income?
Okay. Well, we talked about in the previous show that your payment history definitely is part of your credit report, and your current credit card balance definitely is. So the only one that doesn't appear there is going to be your income. And it's sort of funny that we're issued credit based on credit.
Yes.
We're not issued credit based on
income.
income. So that never shows up on your credit report. It doesn't show up how much you make. And I think that's sometimes how we get into trouble, because usually the creditor will ask us how much we make or to submit proof, but sometimes if you don't submit proof, you might fudge a little bit on the numbers, which is also against the law. If you're falsifying, making those numbers higher, and that could get you into a lot of trouble. So it's funny that we get issued credit on credit, and we don't get issued credit based on our income, or at least I think that should show up somewhere on the credit report. Yes. Although creditors usually do ask you when you're taking out a loan or a credit card or apply for a mortgage, they're going to definitely ask you for your income and compare if you have the ability to pay off those debts.
I have another good question. If my credit score dropped because I got behind on my bills, what's the best way to improve my score?
Okay, and the best way to improve your score is to pay your bills on time, because that is really a big percentage of your credit score. So you need to pay your bills on time and not be late, because that is a big factor. Now, another thing is when we check our credit reports, we need to go through there and see if there's any discrepancies. For example, the very first time I checked my credit report years back, and we used to get it through email because there was no internet. Okay, there was no internet, so I had to wait in the mail for me to get the credit report, and so I'm a junior, and so my dad's a senior, and he has excellent credit score. That's a good thing. So that was reflecting on me as well. But I noticed that there were some accounts that were open even before I was born.
How can that be?
How can that be? But it was just because of the name, because of the similar name. But it doesn't necessarily just because you're a junior, senior, or the third. It could be somebody who has the same name as you do. And it could just be mixed up. And that's a discrepancy that you can fix. And a lot of us want to hire somebody to repair that. You can do it yourself through, now that there's the internet, we can do it online and report that discrepancy, and they'll start an investigation. And if it does come out as it not belonging to you, they have to legally remove it from your credit report. And they have about 30 to 45 days to do that.
Yeah, that's make me remind one time my husband, he likes to check his credit report. And sometimes he said, I have a doubt in JCPenney. And he said, no, I don't. He started to thinking, no, I don't have, and I don't have. And he looked it up. But because he changed his address in JCPenney, he can get his balance from JCPenney, and he forgot the debt.
Oh, wow.
After
so he forgot that he had a debt.
He forgot it.
And he forgot to change the address with that creditor.
Wow. So he have to repair the credit. He has to call the JCPenney.
And explain what happened.
Explain what happened.
Wow. So you see little things like that, and as we get older, it's hard to remember everything. It really is, and now we have so many emails and passwords and usernames and all of this. I don't know how we can keep track of all of that stuff if we don't write it down. But one of the other things you don't want to do is close your credit cards, cancel your credit cards, because that will bring down your score. And we talked about that before, because that shows the history, especially those accounts that you have the longest. But those discrepancies, you can go through it, you can fix it yourself, and you don't have to spend money for somebody to do that.
I have this one. I think a lot of people want to know. My credit card is stolen, and the thief runs up a total debt of $1,000. But you notify the issuer of the card as soon as and I discover the missing. What is the maximum amount that I have to pay according with the federal law?
Okay, so usually if you report it, most banks and credit card companies, you will be liable for nothing. Okay, the most is $50. So that's if you don't, and by federal law that's the limit. So, but most of them will work with you, and basically they'll write off those amounts as not being yours. You might have to maybe fill out a police report, do some affidavits that you weren't the one that made those purchases. But the thing is to report them as soon as possible. Not only that, one of the things that I recommend, and especially, you were saying about checking your credit report, there's been a lot of hacking issues, companies being hacked into, and they're stealing customer information, and they steal your name, your address, your birth date, sometimes your social security number. So we need to monitor those credit reports. And if you ever get informed that a lot of that sensitive information has been stolen, then it might not be a bad idea to put a credit alert on your credit reports. And all you have to do is go to one of the credit bureaus and report a credit alert, and basically they will report to the other two, and basically it puts a note there saying that your identity might be compromised. Might be compromised, not that it is. And before anybody tries to open up any accounts, to make sure that it's you, and they contact you.
Okay, that's very good protection.
Yeah, so especially nowadays, every now and then you hear a certain system has been hacked, and customer information was stolen, and it happens more often than we want. And no matter what we do, we can't protect that information because it's out there.
A score of 720 to 850 is considered an excellent credit score?
Yes, it is. The top is, of course, 850. Okay, so those that have credit scores of 850 are considered excellent. Yes. So and of course, anything in the 700s is considered good, but we got to also consider what type of score we're talking about. The most common one is FICO, and that's the one that we hear about, your FICO score, and then there's other scores. The credit bureaus are now using something that they call a Vantage Score, which is similar to FICO, but they take other things into consideration that FICO doesn't. But still, the gold standard is going to be FICO. So, could you have different scores with different credit bureaus? Yes. They should be pretty similar. So, then if you notice that, hey, one score is way too high than the other, what's going on? And that's where maybe you need to investigate. But they're probably going to be pretty comparable within a few points or another. But we've also got to decide what type of scoring method are they using. FICO, of course, is the most common that lenders look at. One that's gaining popularity is Vantage Score. For example, Credit Karma. I think you've heard those. That creditkarma.com. And that is a legit site. I actually do subscribe to Credit Karma, and you can get the reports from two of the credit bureaus every month, free. And they also give you a score, but the score they give you is not a FICO score. The score they give you is a Vantage Score, which is a new scoring model that the credit bureaus created instead of using FICO. And you might ask, why are there so many scoring models? Because it's all a factor of business and making money. And they're saying, my score is better than your score, because we're selling those scores to creditors and people that are going to lend you money, or even people that might hire you, or for insurance purposes. One thing that a lot of people don't know is that they do check your credit score when you apply for insurance. For example, like for homeowners insurance or automobile insurance, because that shows if you might be a potential risk. And so your premiums are based on your credit score. Now, is there a different score that they use? You bet. There's an insurance score. So there's an insurance score that's different than your what? FICO score. That is created by whom? FICO. Okay? And so they look at that in order to set your premiums. So that's how come sometimes your premiums might stay the same, they might go up, they might go down if you haven't had any claims, okay? Because if you had a claim, of course, that's probably gonna make your premium go up, and depending on the severity of the claim. So they do check your scores, and a lot of companies do subscribe to FICO for different types of scores. Not only that, and when they do that, for example, it doesn't affect your credit score, because that's not coming from somebody who's going to lend you money. That's what we call a hard inquiry, and whenever they do a hard inquiry, then that's when it's going to affect your score. Well, we'll continue on the second half of Making Sense and take a look at more of El Paso Community College student questions. Thank you. Well, we're back to the second half of Making Sense, and we were discussing about questions that ordinary El Paso Community College students have, and we're almost done. I mean, these have been really good questions that our students have. So let's continue on, Claudia, and what's another question that's out there?
One more question is, I only have one credit score?
Well, I think in the first half we were discussing that. Do you think you only have one credit score?
No, we have three.
Well, at the very least,
yes,
three. If that's FICO, and you could have three more if that's what, Vantage. So you could have a lot of scores. But as I mentioned before in the previous half, is that at least we want to see that they're pretty close to each other. We don't want to see one that's here and one that's up here, because then there could be a big discrepancy between what one bureau is showing and the other bureau isn't, and that's where we gotta take a look more into it and try and see what that discrepancy is.
I have another question. Can you name two payroll taxes that are taken out of our paycheck?
Okay, well, you're an accounting student. Can you tell me?
Oh yeah, we already mentioned the FIT,
Okay.
the FICA.
Okay. So that's two of them. We have FIT, which is federal income tax, and that's solely an employee tax. So you're responsible for that tax, and it's based on, and in the previous shows I've talked about W-4 forms. It's based on whether you're single, whether you're married, and how many allowances you're claiming. Usually your allowance is your dependents, including yourself, and so that's how that tax is calculated. But not only that, it also depends how often you're paid and how much you make, because that tax is based whether you're paid weekly, whether you're paid bi-weekly, semi-monthly, monthly. So it all depends on your pay cycle and how that goes. So that's the federal income tax. You mentioned FICA. That's the Federal Insurance Contributions Act, and that's Social Security and Medicare, Social Security and Medicare. And as I mentioned before, a lot of, depending where you work, sometimes we don't contribute into the Social Security system, but we do contribute into Medicare. By the way, let me ask you a little bit about Social Security. So do you think that when you retire or I retire, do you think Social Security is going to be enough?
No.
No?
No.
Why? Don't say that. I only have a few more years to go.
I know. But maybe you have been saving more than me. Well, I think no, because all the prices of the medicine are increasing. The doctors.
Okay, but that's Medicare. I'm talking about Social Security. That's so you see, there's two components. Social Security is when you retire. That's your retirement income. So you think you can live off a Social Security check?
No.
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 And that's exactly right. And that's why we need to supplement with a retirement plan, such as a 401k, such as an IRA, which is an individual retirement account, or a Roth IRA. And those are three different types of vehicles where we can start saving money for retirement. And one of the things that we have is time is our friend, or time is our enemy. I think in a previous show we were talking about compounding interest. Well, that's what's happening when you're saving into a retirement plan, and depending on what is it that you're saving it in, whether it's mutual funds or index funds, that could be earning you maybe 8%, 10%, 12% rate of returns, because you're not going to be able to save for retirement in a savings account. Because savings accounts are good for emergencies, but you're earning less than what, 1% in a savings account. So it's real important that we look, if your employer offers you a retirement plan, that we look at the company that it's offering it. Could either be Fidelity, Vanguard, it could be Principal, Prudential, a whole bunch of different companies, and we take a look at which funds are available, because many of us, we just leave it in the cash account, which means it's a savings account, and it's only earning less than 1%, and we're not investing it in those funds. So you're saying, well, I don't need to know anything about investing. Yes, you do. If you have a 401k, you're investing, and you need to know into the different types of vehicles you can invest that money in to achieve the goals that you want. And so you mentioned the other one, which is Medicare. Okay, so Medicare, Medicare is the health insurance that you get, and is that going to cover everything?
No.
No, definitely not, because Medicare usually covers only 80%. So, and you're still responsible for the 20%, and 20% of a medical bill can be quite a bit. Yeah, it can be quite a bit. And so when you're eligible for Medicare, then we need to be thinking about getting a Medicare supplement insurance. Yes, we're going to have to pay for that Medicare supplement insurance, but it's better than paying the 20%. And there's so many Medicare supplements out there. I mean, that's even another topic for another show. Maybe I can bring in somebody who is more aware of Medicare supplements than I am. But not only that, a lot of those don't cover, you mentioned prescription drugs. I have to get now Medicare Part D, which is, and I have to pay a premium on that for it to cover prescription drugs. And not everything is covered. You know, and sometimes we might have to ask the doctor to write a prescription. He might want to give us a certain medication, but that medication isn't covered. You know, even under regular insurance, it might not be covered, and we might have to go back, hey, doc, write it for something that's more comparable or maybe cheaper or generic or whatever. So
yes, because the medicine without insurance, oh my goodness, is expensive.
So we need to think about these things, and we need to be prepared because, you know, I've had several family members who just live on Social Security alone, and they're not making ends meet. You know, they really aren't, and it's a struggle.
I think because we never realize that we are getting older, and we think that it's gonna be always the life like it is, but it's not. One day we are not can wake up and go to a job and get the same money that we get every month.
That's exactly right. And it's also depends on your lifestyle. And do you want to have a lavish lifestyle when you retire, or do you want to have just a comfortable lifestyle when you retire? And you know, you mentioned something that's real important. We're living longer, you know, and you know, because of the advancements in medicine and so forth, they're keeping us alive longer.
Tell me that. My grandpa is 90 years old.
Right.
So. And he say, I don't want to stay more longer.
That's exactly right. And you know, you know, I'm blessed to have both my mom and dad. They're both 89. My dad will soon be turning 90, and they're very mobile, very active, and even the doctor says, you know, they've escaped every major illness. You know, now what you got to be worried is about falls, because that's the main thing that can kill an elderly person is falls. So.
Completely true. I have another question. If you have caused an accident, which type of automobile insurance will cover damage your own car?
To your own car. Okay, so we had several choices. We had
comprehensive, liability, term, and collision.
Okay, so what do you think? What do you think if you have an accident and you cause damage to your car, what will cover your car?
Well. We already talked a little bit about this. I think collision.
Collision, okay. And you do have, you know, usually when you buy a newer car, you have to get full protection, which we call comprehensive. That means you're going to have everything, because especially if you owe money.
Yes.
Not only that, because the bank or credit union is going to require you to get that in case something happens to that car, so they can be assured they're going to get paid. But not only that, the value of your vehicle is worth more now than it would be 5 or 6 years down the line. So usually as a component of that, comprehensive coverage is collision. So as the car gets older and the loan has been paid off, you know, we might not need collision, and all we need is liability. And based on what state you're in, you need the appropriate levels of liability. And liability covers for those when to damage you do to other vehicles or to other property. Okay, but so if I do damage to another vehicle and my vehicle also gets damaged and I don't have collision, mine is not covered, but the other individuals will be. And then there's whole bunch of other ones we want to get, definitely, especially here being a border city, uninsured and underinsured motorists, you know, because some might not have the appropriate levels of liability, or they might be uninsured. As we still know, there's a lot of people out there driving with no insurance at all. You mentioned another one, term. That doesn't apply to automobile insurance. That applies to life insurance. So we have term life insurance, which is usually what we want to get, is term life insurance. And it's called term because it ends at a certain age. Oh, okay. So after a certain age, it ends and you don't have it. But usually by that age, you don't need the life insurance because hopefully your house is paid off, your kids are grown up, they're off to college, they're on their own, and you don't have anybody else to support. So the term ends usually in your upper 60s or 70. Okay.
I have one more question. If you went to college and earned a 4-year degree, how much more money could you expect to earn than if you only had a high school diploma? 10 times as much, 20% more, or 70% more?
Wow. So you know, we talked about this question earlier, and you said you thought it was how much? 70% more. Well, I wish. I wish it was 70% more. But in reality, it's going to be a little bit more than 20%. A little bit more than 20%. But let's put this into perspective, okay? So if we only have a high school degree and you have a bachelor's degree, over your lifetime, the life that you earn money, you will be earning 1.1 million more.
Wow.
Than somebody with a what?
High
school degree. Okay. Now let's take a little bit further. If you have your master's degree, okay, which is 2 more additional years of schooling, so if you have your master's degree, you'll be earning about 1.3 million more than somebody with a high school degree. And you know, that's one of the things, and that's one of the issues we have here at the college is the way to better our lives is through education, okay? And that doesn't mean you have to get a bachelor's degree. You could get an associate's degree, or you could get a certificate of completion, but any other type of level of education beyond high school is going to bring you more earning power. And that's what we need, because we need to better people's lives. We need to get them out of the poverty level, and we want to be able for them to support their family, and not only that, but provide back to the community. Okay? And I think we have time for one last question.
Oh yes, I have one from one of the members of our crew.
Okay.
She wants to know about the FSI benefits.
The FSA. Okay, so during break, one of my crew members asked about FSA, and that's a flexible spending account. A lot of employers offer this flexible spending account, and there's 2 types. There's one for medical expenses, and there's one for dependent care benefits. So the most common is the medical expenses. So what happens is you elect basically when at the beginning of your plan year how much you want to contribute to this FSA. And so let's say I want to contribute $1,200. So that will be taken out of my paycheck over the 12 months, but at the beginning of the plan year, in our situation here at the college, which is September 1st, that $1,200 is available for me to use even though it hasn't been taken out of my paycheck. And usually what they'll give you is they'll give you like a debit card, a Visa or a MasterCard debit card. And those funds are loaded in that card, and you can use those funds to pay for your copays, deductibles, prescriptions, eyeglasses, contact lenses, contact lens solutions, blood pressure monitoring machines, glucose monitoring machines, Band-Aids. There's a whole list. And if it's prescribed by your doctor, it's probably going to be covered under FSA. So, and I can use this card wherever, like at the pharmacy, at the doctor's office. You could use it for eye exams, for dental appointments, for anything that's medical. Now, the only thing you can't is for over-the-counter items. So like for, let's say, ibuprofen or Tylenol or, let's say, heartburn medication, you can't cover those unless you get the doctor to write a prescription for you. So, but it's a great benefit because you won't be taxed on this amount that is being withheld. Well, thank you, Claudia, for coming back and going over some of these questions that the students had, and we'll see you next time on another episode of Making Sense. Goodbye.